Today, folks, the Canadian government is coming for your dividends, and I wish I was joking. However, if you're like me and you believe the Canadian banks to be a staple to one's portfolio that have had years of compounding dividend growth and will likely continue to, and might start to stall out a little bit, is just when it looked like we were heading into a recovery with the largest companies being the banks in Canada. The government is stepping in because they have a deficit problem, they have a spending problem, and instead of taking it out of their pocket and doing layoffs, what are they going to do? They're going to come after the largest companies. Right now, this is a conversation you'd appreciate. Hit that like button as we review these new policies, as we talk about the big six banks and my thoughts surrounding it. But yes, if you haven't seen the articles, the change comes as Prime Minister Justin Trudeau's government faces a deteriorating fiscal outlook and a slowing economy, while it ramps up spending to help residents cope with inflation, prop up the healthcare system, and compete with the U.S. on low carbon initiatives. Doesn't matter whether you like liberals, doesn't matter whether you like Justin Trudeau. I'm not going to make this political. The fact of the matter is we have an outpacing deficit, and rather than laying off, you're taking a look at government spending and cutting some things and laying off some employees, we'll just take it from the largest companies in Canada and hinder the Canadian economy's growth, especially if you are an investor. Now, don't get me wrong, not all these new policies are bad for the end consumer, but most of them a lot of them are going to hit the bottom line of the big banks. Now, as a Canadian investor, you have to recognize Canada is a much different economy than the US. Our biggest industries are primarily we have mining, we have energy, and we have financials, whereas tech companies have just not made their way into the largest cap companies in this country, though we've tried. But because there's only a few big tech companies, too many dollars chased too few companies, and it led to a much bigger bubble than we saw in the crash with the US tech companies. Because Shopify, though very, very expensive still as a tech company, is still down 50% from the bubbly highs before the burst. And this is the largest tech company in Canada, next to Constellation Software, that trades at 104 times price to earnings multiple. And I just have a hard time buying it at these values. And even the smaller tech companies are still highly expensive, and they've had a hard time getting any traction into growth from the capital appreciation because they just trade at expensive values. I mean, even Nvidia is trading at a 70 times multiple, but is actually growing at a deserved pace for that multiple, whereas these companies just aren't, in my humble opinion. But my favorite investments, and especially if you're looking for passive income and compounding dividend growth, you're going to look at things like VDY, the Vanguard FTSE Canadian High Dividend Yield ETF, that market cap weights the best Canadian dividend stocks from Royal Bank and TD to Enbridge, and just so many great companies in the telecommunications space. And if you like the banks like I do, it's likely you're buying these equal weight bank ETFs like the Horizon Equal Weight Bank Index ETF that pays a monthly dividend, gives you really low expense ratios, and is just a wonderful place to get that exposure. But now you got to kind of question, as we head into a recovery, as we head into an interest rate cut cycle this year that should only benefit these companies, the government's like, you know what, we're going to take some of those benefits away. So first, before we talk about the policies, take a look at the banks, where they sit this year, with Royal Bank being up slightly, TD continuing to get hit from the drama they experienced from last year, from the fallout of First Horizon, from a lot of non-disclosures around some dealings in the US. I mean, there was a lot of controversies currently going on with TD that could lead it into a value setup with its almost 5% yield. Makes it very, very intriguing, and I'm honestly going to be shocked if these earnings don't come in better than they did last year, as they've already put so much loan loss provisions aside to protect themselves against some of the lower quality loans. Is that something Bank of Nova Scotia stated? The CEO said, let's just jump the gun, put some extra capital aside so we can not deal with it as much into 2024. So I'm expecting Bank of Nova Scotia to have a good quarterly report, especially for Q4 of last year. So it's something to look forward to on the earnings. Canadian Imperial Bank losing a bit of steam after being the best performer coming out of the October low of last year. I mean, it's up 35% still from that drop. National Bank, still one of the best performing bank stocks, just about to peter an all-time high here. It's still only down about 4%. And then Bank of Montreal, which is lacklustering a bit here, down about 2%. I don't know what of these are going to perform the best. I'd prefer to just have exposure to all of them, because if we take a look at the total returns, and excluding dividends, we're kind of just looking at capital gains here, and we zoom out to the max charts on all these banks. We can see they've all had very, very similar performance. Some have outperformed over time. Some lately have started underperforming, like Bank of Nova Scotia. But the total returns have been absolutely absurd. If we go back to 1990, looking at about a 30 to 40 year period, we're talking about a couple thousand percentage points in gains, and let alone the dividend compounding over that time and collecting those dividends that could easily support your expenses. Now, I don't think we're going to see the same kind of return returns as we have in the past. It really depends on immigration and whether we continue to have outsized immigration, which is proving to be a big problem on the infrastructure in Canada. But now, forget immigration altogether. We have policy problems, right? And first, let's talk about the good policies, because the government is introducing measures to ensure basically that Canadians are treated fairly by their banks. We know these banks have nefarious practices, and one of them being that there is no like free bank account. If you open a bank account and you don't put a minimum amount in it, they charge you a monthly fee. In fact, I was really annoyed with TD because we opened a new account and they said the minimum amount was $3,000. So 2 days later, we put $3,000 in the account and we still got that monthly charge. And I said, why did that come in? And he said, oh, well, you didn't fund it the first day. Like, they are very conniving about getting fees. So the Canadian government is going to make it so there are accounts that have no balance fees. And there's a ton of other things coming into play here that have to do with nefarious practices on NSF charges. They're always pushing for, how can your account go below zero? That was another really weird thing the bank did. Instead of running out of money and just declining your card saying, oh, sorry, you can't spend anymore, you've hit zero. Well, we're going to let you go below zero and then we're going to charge you a non-fund fee. Like, it's just interesting how the banks go about doing this. It's like your savings account is a credit card. It can go below zero. I mean, think about that. Isn't that interesting how the banks have navigated kind of manipulating like low income people that are broke? So I get why the government's doing some of these things, but where it's really going to get convoluted and really mess up your investments is in the new corporate tax rates. The federal government also launched a basically permanent change to the sector's corporate income tax rate, just the finance sector. We're talking about insurers, we're talking about banks, where they're going to raise an estimated couple $2 billion over 5 years. It's increase the tax rate about 1.5 percentage points to 16.5% on taxable profits over 100 million. So 100 million sounds like a lot of income before you hit that extra tax bracket, but keep in mind these banks are posting tens of billions of dollars in profit each year. So I mean, 100 million is nothing, and they're not going to write those off because they obviously want to pay dividends and have income. That sucks for people that are looking to see excess growth and obviously, continued dividend compound into the future, because an extra 1.5% doesn't sound like a lot to you, but when you're talking about companies that make billions of dollars, it definitely hinders their earnings per share and will hinder the long-term stock growth. Now, there's more going on here, as the decision means that basically the 6 largest banks will enter 2024 with their requirement to hold a common equity tier 1 capital of at least 11.5% of risk-weighted assets. Now, this is also a good benefit because currently all the banks have comfortable levels, except for Canadian Imperial and Bank of Montreal are pretty close to these minimums, but this is what we're talking about with capital minimum requirements in case they start seeing shaky loans default. That has a lot to do with loan loss provisions and things of that nature, so this doesn't really have a concern at the moment because most banks already meet their capital requirements. But then finally, and something else very intriguing to me, basically if you thought your stock was undervalued, you'd be incentivized to buy it at a good, you'd buy it and there'd be tax deductions in relation to buying common equity in stock. But it kind of falls as an economic statement released in November 3rd, 2022, that the Department of Finance announced its intentions to implement a 2% tax on share buybacks applicable from January 1st, 2024. So this year, if you want to buy your own shares back, there's going to be tax implications. And I'm sure most people were unaware that what the tax implications already were on this, but this really hinders the incentives for companies to grow and benefit shareholders. I know we're only talking about 1 to 2 percentage points, but it adds up when we're talking about billions of dollars, and it adds up when it hits the bottom line on earnings reports. Now, as somebody that loves the Canadian banks, this definitely bothers me immensely. And I've told you, as a Canadian, when I look at a lot of Canadians' portfolios, I think they are too heavily exposed to this economy. I have made insane returns, and the vast majority of those returns did not come from this economy. In fact, my Canadian investments are by far the lowest. I think as a total in the household between like my wife and I, if we're not talking about the real estate we hold, just in our stock portfolios, Canadian investments maybe make up 15 to 20% of our entire investments. Now, if I was in retirement and I was looking for dividend income, maybe I'd allocate a bit more, but you have to recognize that there are very few really great investments in Canada, and even so, those great investments lackluster the performance of the S&P 500 over long periods of time. So you do want to make sure that you are well divested out of this country and just keep yourself mitigated. And I know it sounds horrible as somebody that even invests in the Canadian economy, but you have to recognize the past and what is expected in the future, and it's just not as bright as I think it once was in the past, and I don't expect to see the same kind of growth returns that we've seen in the past from these banks. I think Canada is kind of coming out of this growth era into a struggling era for the next 5 to 10 years, and it's something that I think the US will prosper well and beyond it, because they have the leading AI tech companies that are going to propel a lot of margin expansion that, Canadian banks just don't have the privilege of, which will hinder the broader Canadian ETFs, especially the equal weighted ETFs, right? But these are just my personal opinions. I'll pass it off to you. I'd love to know what you think in that comment section below.